I, Professor B.K. Jain, Dean, Bhyani Institute of Science and Management of Bhyani Group of Colleges, welcomes you in this video lecture series on the subject Management of Financial Services of MBA 3rd Sem. This is 6th lecture in this series, and the topic devoted for this lecture is regulatory functions of Reserve Bank of India. As you may be all aware, RBI is known as regulator of the entire banking industry. It is not only country's apex bank, but also bankers' bank, as well as banker of the government and country's banking regulator. Now, if I narrate all functions under regulatory functions, I would first of all take licensing. You all may be aware that a bank is a banking company, and as banking company, it is required to be registered with Indian Companies Act 1956 as amended in 2013. After getting it registered with Indian Companies Act, it goes for license, and for that it has to make an application to the Reserve Bank of India. And unless license is issued by Reserve Bank of India, no banking company can start business of banking in our country. So licensing is one of the very important regulatory power of Reserve Bank of India, as unless license is issued, no bank can function. And in case license is withdrawn, immediately a bank has to close its business in our country. So very important function of RBI is licensing. It is a monopoly power with Reserve Bank of India, and once license is issued, nobody can intervene, and even government cannot make any help to that applicant. Now, another important regulatory function which Reserve Bank of India perform is the branch expansion program. Reserve Bank of India has undertaken a very detailed branch expansion program, and for opening a branch, RBI's permission is required. For closing a branch, RBI's permission required. Why RBI permission? Because Reserve Bank wants to ensure orderly growth of bank branches in the entire country. It wants that branches should be opened only in the areas where branches are required to be opened, that is in remote areas and in rural areas. Now, another important thing which RBI is today is ensuring that number of ATMs is also constantly increasing, and Reserve Bank of India wants that all branches should invariably have ATM in its branch, so that there is no rush inside the bank branch, and mostly functions like withdrawing cash as well as depositing cash can be done at the ATM itself. So number of ATMs is also increasing, number of branches is also increasing, and Reserve Bank of India is regulating that required number of branches and required number of ATMs are opened, particularly in the areas where presently branches are lacking. Another very important function which is Reserve Bank of India performs is the statutory inspection under RBI Act, as well under Banking Regulation Act. Reserve Bank of India has the statutory power of conducting inspection of banks, all types of banks, that is even the commercial banks, and in case of cooperative banks and RRBs, Reserve Bank of India has delegated this power to the another important institution created at national level, that is NABARD. So mostly commercial banks are being inspected by Reserve Bank of India, and these cooperative banks and RRBs are being inspected by NABARD because they both primarily deal in agriculture financing. While conducting inspection, Reserve Bank of India is also arranging supervisory rating of banks, and through 6 angles, which is popularly known as Camel's rating, it is rating the performance of banks. And in this Camel's rating, there are 6 words. C stands for capital adequacy. Now, capital adequacy is the norm or the amount of capital required against the total assets. Presently, this capital adequacy norm is 9%, which is required to be attained or achieved by all commercial banks and cooperative banks. Another is asset quality. Reserve Bank of India is very particular on the quality of assets because the entire deposits are invested mostly in loans, and Reserve Bank wants that loan should be safe and no amount of loan should go to bad or doubtful debt. The third is word M in this Camel's rating, which stands for managerial efficiency. Banks should always look for the efficiency of the management, and all management decisions should be efficiently taken by banks. The E stands for earning, means bank should not go in loss, it should always earn profit and should provide a dividend to its shareholders. L stands for liquidity, because no bank should suffer any lacking so far as the liquidity is concerned. And the basic banking definition also provides that whatever money in the form of deposit are accepted from public, they are to be paid on demand. No bank can afford to say no to a depositor when he comes to the bank branch for withdrawing money. So liquidity is also one of the very important things on which Reserve Bank of India lay emphasis while conducting inspection of a bank. And lastly, systems and procedures should be such through which bank functions more effectively and more efficiently. So on the basis of this Campbell's rating, it provides A category, B category, C category, D category, and on the basis of this category, Reserve Bank of India decides which are the banks which are to be frequently inspected, which are the banks doing nice and there is no need of frequent inspections. Another fourth point in the regulatory functions of Reserve Bank of India is power of issuing directions and instructions. Now, Reserve Bank of India, in the interest of banking sector and orderly growth of banking sector, often issues directions, often issue instructions, and whatever directions, whatever instructions are issued by Reserve Bank of India, all banks are expected to follow that. No bank can afford to disobey the directions issued by Reserve Bank of India. For example, last year, Reserve Bank of India issued directions that small children with 10 years and above age can open their bank accounts. But these small kids may open an account, but banks would not provide loan. So these are the type of directions. Reserve Bank of India issues often directions with respect to non-performing assets of banks. So whenever Reserve Bank of India issue directions and instructions, they are required to be followed by all commercial banks. Reserve Bank of India's another tool of getting information from banks is calling for returns. Reserve Bank of India calls for various types of periodic returns. These returns are weekly returns, fortnightly returns, monthly returns, quarterly returns, 6 monthly returns, annual returns, and some special returns, through which it calls for information from the banks, and then wherever required it needs or it exercises control. For example, there is a return of cash reserve with the bank. It is a weekly return in which the banks are providing information about CRR maintained. If a bank does not maintain CRR as per the requirement of Reserve Bank of India, through the weekly return, Reserve Bank of India comes to know whether CRR has been properly maintained or not. Because maintaining minimum CRR or less than minimum CRR or maintaining more CRR, in both the cases, Reserve Bank of India immediately takes action and writes a confidential letter to the Chief Executive and Chairman of the concerning bank to look into this matter, because if more CRR is maintained with Reserve Bank of India, the concerning banks would be losing interest on that. Next is amalgamation of banks. Whenever one bank wants to get merged into another bank, Reserve Bank of India comes in picture, and Reserve Bank of India's permission is invariably required before merging. A few years back, it was the Bank of Rajasthan which was merged with ICICI Bank. In that case also, RBI's permission was invariably required. Without the permission of Reserve Bank of India, two banks or one or more banks cannot be merged with another bank. Another very important function of control is credit control by Reserve Bank of India. Now, this is very crucial function performed by Reserve Bank of India. Besides money in circulation, that is currency as well as coins, many times more than the money in circulation, credit is in circulation in our country. So Reserve Bank of India's prime concern is to exercise due control on credit. There are two methods of credit control. One is known as quantitative method, another is known as qualitative method of credit control. Under the quantitative methods, there are four important measures which Reserve Bank of India is taking. One is bank rate. By making changes in bank rate, Reserve Bank of India exercise control on credit. And making changes means bank rate is the rate at which Reserve Bank of India discounts and rediscounts government securities. And by changing this rate, it exercises control on the credit. Then open market operations. At times, Reserve Bank of India directly comes in the market and exercise control. For example, when the dollar prices are rising, it releases dollar so that the conversion price of rupee in terms of dollars may be controlled. Another is changing CRR, cash reserve ratio. Reserve Bank of India is often changing the CRR after taking a review of the economy, bi-monthly review. As I told earlier, Reserve Bank of India's main function is also to undertake a bi-monthly review of the country's economy. This review is undertaken 6 times in a year, and based on that review, it often changes CRR rate. This CRR rate is presently 4%. It is fixed somewhere between 3 to 15% as per RBI Act 1934. Now, whenever the CRR is changed even by 25 basic points, it makes a difference of 15,000 crores. And if CRR is raised, 15,000 crores coming out from banking industry are blocked in Reserve Bank of India. If the CRR is reduced, low-level funds of banks are increasing. It also undertakes control through controlling statutory liquid ratio. Presently, this ratio is 21.5%, and in this ratio, all banks are required to maintain statutory liquid ratio in the form of gold or encumbered government-approved securities. And by changing the rate of SLR, it exercises control on the credit circulation in the country. Under the quantitative methods, it has selective credit control, and then it is credit rationing. Credit rationing means that rationing the amount of credit being disturbed by changing margins, etc., so that it controls the quantum of credit being advanced by commercial banks. At times, another is moral persuasion. Reserve Bank of India morally persuades banks to be careful while making recoveries and controlling their loans and advances. And last is direct action. Whenever the directions of the issued by Reserve Bank of India, instructions issued by the Reserve Bank of India, inspection report observations not complied by the concerning commercial bank, it takes action and imposes fines and penalties. And finally, it has a power of even cancelling the license of a particular bank if it finds that the bank is not working properly, it is working against the interest of depositor. Finally, it has a power even to cancel a license. Nowadays, Reserve Bank of India is in limelight because of two important issues or challenges which the entire banking sector is followed. Only a few days back, Finance Minister made a very strong statement that Reserve Bank of India would be compelling all banks to provide information about the bad loans and restructured loans, because NPAs, non-performing assets of commercial banks, are increasing at a very high rate. Another thing is there is a debt restructuring, means restructuring the repayment period of the loan, and both these main challenges, a new term has been coined, and that is stressed assets. Stressed assets are the assets which are under a great stress, and only God knows whether this amount of asset, that is loans and advances, the commercial banks are likely to get or not. So everybody in the Government of India, Ministry of Finance, including Finance Minister and Governor of Reserve Bank, Mr. Rajan, they are worried about the increasing stressed assets, and only 2 days back there was a news in the paper that the total amount of stressed assets have crossed 11% of the total loans and advances. So this is a very serious issue. RBI is very much concerned, and with RBI, even the finance minister is very much concerned and worried about, and they all are taking necessary corrective measures to overcome this problem. Thank you, and thank you.